swaps on mortgage bonds, credit default swap that will pay off if the underlying bond fails.
You want to bet against the housing market?
Dr. Michael Burry, the man most famous for predicting the 2008 housing market collapse, has made a new bold prediction regarding the next crisis, one that he claims will make 2008 look mild. Unlike most of his other investments and calls, this one in particular is rather scary, as it outlines a theory and hypothesis in which he believes not only is there going to be a massive financial collapse, but something much deeper will occur going beyond Wall Street. Based on a book called The Dying of Money, Burry believes in a rather apocalyptic scenario that ends with violence and war. In this video, I will attempt to summarize why he says the end is near and how this scenario could lead not only to economic collapse, but something much more serious. Unfortunately, I first need to explain some economics. Most of you already know much of this stuff, so you can skip ahead a bit to 341. The first bit is for all the viewers who don't fully understand how the US Federal Reserve functions. In order to stimulate the economy, the United States and other governments around the world, by way of their central banks, print money. They do this by buying their own government bonds in the open market. I will explain this in more detail later. They occasionally, as they did during the COVID crisis, buy corporate debt too. They literally buy this money with money they digitally print. That money comes from nowhere. Their intention with this behavior is to stimulate the economy by reducing interest rates. When you buy a bond, you push the price up, which then decreases its yield. It's a phenomenon that may confuse you. So here's an example. A 1-year bond is trading in the market at $97. This bond is said to have a par value of $100. So you can buy the bond at $97, wait a year, and receive $100. A comfortable 3% yield. In simple terms, the Fed buys bonds, bond prices go up, and yields go lower. If interest rates go down, businesses borrow more money to invest and jobs are created because investments create jobs. But if an economy is running at 2% interest rates, then even investments yielding a low 2.5% return would be invested in because they can earn the difference, 0.5%. This makes all kinds of stocks extremely attractive as low interest artificially increases stock prices, acting like gravity. The higher the interest, the less appealing stocks look. The lower the interest, the more attractive they are. So you're probably thinking, if you print all this money and decrease interest rates, shouldn't we get inflation immediately? That's at least what we learned in school, right? Print too much money and inflation becomes a problem. Well, actually, it does cause inflation immediately, but not in the way you learned in school. It creates inflation immediately in stock prices. The printed money doesn't go to your average citizen. It goes to corporations who sell their debt to the central bank. It goes to big investors who sell their government bonds back to the central bank because they can earn more in stocks this way. They are clever, rich, and sophisticated people. They know a stock yielding even a stable 3% will earn them more than the current bond, which yields only 2%. So the big question is, when does printing become a problem? To start, we have to understand that central banks look at food prices, general household items, gas prices, housing, and other goods that the average you and me purchase almost every week. Bundle these together and call them CPI or Consumer Price Index. This statistic is what is used to measure inflation in certain goods. Keyword there is certain goods. Now let's imagine a scenario. You have 100 people in an economy. 2 people are insanely rich and the rest get by fine but don't have much extra to invest or save each month. They use their savings to purchase mediocre goods, a new phone, or a new TV. Why would they invest that extra $100? It's too little of a sum to have any effect, even in the long run, on their lives. Now we look at the rich. They already have the TV, the car, and maybe a few houses. Where does this extra savings go? Well, straight into stocks, and maybe a new yacht every so often. Fine dining and other sorts of things that are not in the CPI basket. So watch this. Mr. Central Banker, aka Jerome Powell, comes along and prints an extra $1,000. Give this money to the rich man and what will he do? He already has the car, he already has the houses. He will obviously invest it straight into the stock market. Bam, stock market inflation, stock market goes up. This is what's been happening since 2008. Just take a look at this chart. The extra $1,000 does not affect the CPI basket. The rich man is not going to suddenly eat twice as much or buy 10 more TVs. The stimulus money from the central bank inflates only one thing, the stock market. Give this $1,000 to the poor normal man, what will he do? He may treat his wife to dinner, buy this kid a bicycle he couldn't afford, fill up his truck, pay his rent, or maybe buy the new iPhone. He's not wrong in doing this, it's most likely his best option. A mere $1,000 in the stock market will have no effect on his life, even in the long term. The point here is that central bank printing does cause inflation. It causes inflation immediately in the stock market because that's where the money goes. Only when the money gets out into public hands, think stimulus check, does inflation in the CPI reveal itself. So when does inflation become a problem? Remember, it's not all bad. Inflation becomes a problem when it isn't accompanied by its great friend called economic growth. Inflation has a fascinating effect of raising bond yields. Investors don't want 2% bond yields if inflation is at 3%. They're not getting real returns if this is the case. So they simply do this. They don't buy bonds. What happens when someone doesn't want to buy your house? You lower the price. No one's buying bonds, bond prices go lower, and therefore yields rise. Remember, if no one buys the bond, the price goes from 97 to 95. It's simple supply demand. At the end of the bond's life, you get $100, so the yield rises as the price falls. The inflation problem occurs when the average man gets his hands on some of that sweet, freshly printed government money. The poor man was able to affect the CPI because he actually purchases goods in the CPI basket. Give every poor man or woman in America $1,000 and they will go out and buy a limited supply of goods that are usually part of the CPI basket. A limited supply of goods, supply demand, and prices rise. Voila, classic CPI inflation. So where is this leading to and what do we do? There are essentially only two outcomes in this scenario that we are currently living through. If inflation in the CPI caused by the average American stimulus check, opening of the economy, increasing oil and commodity prices, gathers momentum, it will finally unleash the poisonous inflation potential of America. Everyone who holds dollars or dollar-denominated debt, meaning every single country in the world, will pay for America's inflationary sins. Fortunately, poorer countries who are indebted to America should actually benefit from this, since paying back debts after inflation takes place is actually a lot easier if you have other assets not denominated in US dollars. Under this scenario, inflation will need to increase by this much. Look at that red line in the following graph. As you can see, in 2008, the central government began its shenanigans. In a stable economy, money supply should increase sort of in line with GDP growth. As you can see above, money supply has actually increased far more than that. That gap, indicated by the red line, is inflationary potential. It now basically just sits in stocks. Under this scenario, money supply needs to come back down to real GDP. The central bank, they won't do this. They won't tighten. That would hurt too much. Even small changes in the interest rate cause the stock market to take a hit. But the naturally occurring forces of inflation will do it for them, and prices in the economy will inflate to catch up with the money supply. So what happens in this scenario? Inflation goes out of control, yields rise, the central bank gets spooked and tries to raise rates a little. Economy tanks due to raised rates. 6 months later or maybe a year later, the currency has found an equilibrium by depreciating around 70% relative to the price of real goods, not relative to the price of other currencies. Or the currency has found equilibrium because they removed that money from the system, which is also highly unlikely. Then we have scenario number 2, a highly probable outcome that we will call Japanification. The country of Japan has been doing QE for much longer than the US. The reason why they haven't blown up in an atomic bomb of inflation is because this money never reached the hands of the Japanese middle class or poor, so that inflation couldn't occur in CPI. However, inflation did occur everywhere where the rich were, as it was them who had more access to this money. America's central bank could, by way of printing even more money, buy more bonds and push down yields. This could let inflation run for a little while and hope it doesn't gain momentum. If inflation gains real momentum, which it could because they're giving away money to the middle and lower classes, then they cannot follow Japan's lead. If inflation remains muted and low, the real issues of wealth inequality will only persist and worsen. That's not to say that the leaders of the governments are inherently sinister in their motives to conduct QE, which disproportionately benefits the rich. It's just human nature that people would rather be instantly gratified leaving future generations to pay for inflationary problems. So what happens here? Inflation rises a bit due to stimulus checks. Central banks remain unconvinced that inflation will gain momentum. If inflation does not gain momentum, the central bank will continue to print until they see GDP growth. Stocks go up, but until the wealth gap is too extreme and a revolution takes place. This could take 10 years or 100 years. Now, this scenario may sound crazy and impossible, but as history has shown over and over again, hyperinflation due to excessive money printing and a widening wealth gap are always a recipe for disaster. Thank you guys for watching, and please make sure you hit that subscribe button if you have enjoyed.